Welcome to the 21st episode of our series. Today, we are diving into the complete Weinstein method. If you have ever felt overwhelmed by the noise of the market, this framework is your solution. Stan Weinstein's four-stage system is widely considered the gold standard for long-term investors who want to stay on the right side of the trend. By learning how to classify the life cycle of a stock, you will stop guessing and start trading with a clear, objective roadmap. Whether you are a total beginner or looking to refine your strategy, this episode will teach you how to identify high-probability setups and avoid the most dangerous pitfalls of the financial markets. To understand why this system works, we have to look at the event that created it. In May 1962, the S&P 500 dropped 6% in a single session during the Kennedy slide bear market. Between December 1961 and June 1962, the index fell 28%. Stan Weinstein was an undergraduate at Hofstra University at the time, trading a small portfolio on margin based on newsletter tips. He lost most of his capital. Instead of quitting, he spent the next decade studying thousands of stock charts. That 1962 loss became the formative event of his career and the origin of what we now know as stage analysis. By 1972, Weinstein was publishing the Professional Tape Reader, a bi-weekly newsletter mailed from Hollywood, Florida, that ran for roughly 25 years. Subscribers paid for a market stance recommendation and a watch list. Weinstein had to defend both in print every 2 weeks. That discipline of being publicly wrong on deadline shaped the framework more than the 1962 crash did. In 1988, he published Secrets for Profiting in Bull and Bear Markets, a book of roughly 250 pages aimed at retail investors. His core thesis was simple: most stocks at most times are not worth trading, and a four-stage taxonomy is the cheapest way to tell which ones are. Weinstein's entire method rests on a single, simple moving average, the 30-week SMA on weekly charts. This roughly corresponds to the 150-day simple moving average on daily charts. The slope of this line tells you which stage a stock is in. A rising 30-week moving average with price above it signals a Stage 2 advance. A flattening moving average with sideways price signals a Stage 1 base or a Stage 3 top. A falling moving average with price below it signals a Stage 4 decline. Weinstein insisted on weekly charts because daily noise obscures the major trend, and he wanted his readers to focus on the big picture. Let's look at Stage 1, the basing phase, using NVIDIA in October 2022 as our example. After peaking in November 2021, NVIDIA entered a brutal Stage 4 decline. By October 13, 2022, the stock bottomed near $112 per share, split adjusted. For the next several months, price moved sideways in a range, while the 30-week moving average flattened after falling. Volume dried up compared to the distribution phase. This is classic Stage 1 behavior. Weak hands exit, institutions accumulate quietly, and the stock builds a foundation. The base took nearly 5 months to form, and it is vital to remember that patience is required because nothing dramatic happens yet. In Stage 1, volatility contracts. Price oscillates in a horizontal range, often for 12 to 24 weeks or longer. The 30-week moving average gradually flattens as the downward momentum dissipates. Volume characteristics are key here. Overall volume declines from Stage 4 levels, but occasional above-average volume spikes appear on up weeks, suggesting institutional accumulation. Relative strength stops deteriorating and may begin to improve slightly before price breaks out. Indicators like on-balance volume and accumulation distribution often turn higher before the price does, offering an early clue that the stock is preparing for a new move. Moving to Stage 2, the advance, we see NVIDIA's January 2023 breakout. On January 23, 2023, the stock broke out of its 5-month base and entered a powerful Stage 2 advance. The stock reclaimed the 30-week moving average with a surge in buying volume. Over the next 18 months, NVIDIA rose more than 1,200% from its October 2022 low, forming multiple consolidation bases along the way. Each base was characterized by tight price action before the next breakout. The 30-week moving average acted as dynamic support throughout the entire advance. This is the stage where Weinstein method investors capture the bulk of their gains. Weinstein required 3 specific confirmations before declaring a Stage 2 entry. First, price must break above key resistance on a weekly close. not just an intraday spike. Second, the 30-week moving average must be rising or at minimum turning upward. Third, breakout volume must expand significantly, ideally 40 to 50% above the average weekly volume. A breakout on weak volume is suspicious and often fails. The ideal buy point is the breakout week itself, or a pullback to the breakout level that holds as support, which is known as the resistance to support flip. Zoom Communications illustrates a textbook Stage 3 top. The stock reached an all-time high closing price of $568.34 on October 19, 2020. After that peak, the 30-week moving average began to flatten. Price action turned choppy with wider swings and more volatility than during the prior advance. Zoom failed to make new highs despite positive headlines about remote work, and failed breakouts increased. This is distribution, institutions selling shares into public demand, while retail investors interpret the sideways action as healthy consolidation. Two telltale signs separate Stage 3 from a normal Stage 2 consolidation. First, volume behavior inverts. Down weeks show heavier volume than up weeks, indicating distribution rather than accumulation. Second, relative strength versus the S&P 500 weakens even while price may still look strong on an absolute basis. The Mansfield Relative Strength line slopes downward toward the zero line. Key support levels get tested repeatedly, and each test weakens the floor. Stage 3 can last for months, luring investors into a false sense of complacency before the real damage begins. Peloton Interactive demonstrates the devastating cost of holding through Stage 4. The stock peaked at $157.83 in February 2021. By August 2023, Peloton closed at $5.41, its lowest price since the 2019 initial public offering. That represents a decline of more than 96% from peak to trough. Throughout this decline, Peloton stayed below a falling 30-week moving average. Every rally into the moving average was a selling opportunity, not a buying one. Bear market rallies were sharp but short-lived, trapping dip buyers repeatedly. Stage 4 psychology follows a predictable path. Hope turns to denial, then to panic. Investors often average down because they cannot accept selling at a loss. Meanwhile, short sellers and institutions sell into every rally. The Weinstein method's core rule for Stage 4 is simple: do not be long. Wait for a complete Stage 1 base to form before considering re-entry. There is no need to try to pick the bottom. Most of the damage in Stage 4 happens not because the stock falls, but because investors refuse to accept that the stage has changed. Capital preservation is your only priority here. Relative strength in the Weinstein method is not the RSI oscillator you might be familiar with. It measures how a stock performs versus a benchmark index, typically the S&P 500. Weinstein used a specific variant called Mansfield Relative Strength. The formula is Mansfield RS equals the quantity of the stock price divided by the index price divided by the 52-week moving average of that same ratio minus 1, all multiplied by 100. The result is an oscillator centered on zero. Weinstein applied this exclusively on weekly charts with a 52-period setting. The zero line on the Mansfield Relative Strength indicator represents the stock's performance exactly equal to its 52-week moving average. A reading above zero means the stock is outperforming the S&P 500 and shows leadership. A reading below zero means underperformance. Weinstein insisted that Stage 2 breakouts must be accompanied by rising Mansfield RS, preferably crossing above or already above the zero line. When Mansfield RS is far above zero and has been there for an extended period, the stock is a market leader. Dips in such stocks within a confirmed Stage 2 can offer lower-risk entry opportunities. One of the most powerful structural signals within Stage 2 is the resistance to support flip. It occurs when a prior resistance level becomes new support after a breakout. For example, imagine a stock capped at $60 for 5 months. It breaks above $60 on strong volume, pulls back during a market dip, and holds at $60 before rallying again. That level flipped from resistance to support. This behavior confirms genuine demand and validates the Stage 2 advance. If price breaks above resistance but quickly falls back below it, the breakout is false and risk increases sharply. Weinstein's method demands a top-down approach. Step 1. Determine the stage of the broad market index, such as the S&P 500 or Nasdaq 100. If the overall market is in stage 4, aggressive buying makes little sense regardless of individual stock quality. Step 2. Identify which sectors are in stage 2. Capital rotates between sectors in identifiable waves. Step 3. Select leading stocks within those strong sectors. A stock in stage 2 within a sector that is also in stage 2. While the broad market supports risk-taking, offers the highest probability setup. Fighting sector rotation by buying a stage 2 stock in a stage 4 sector is essentially swimming against the current. The Weinstein method adapts to different time horizons without changing its core logic. Long-term investors focus on full stage 2 cycles that may last 6 to 18 months, holding while the 30-week moving average rises and exiting only when stage 3 transitions toward stage 4. Swing traders may apply the same 4-stage structure on daily charts, using a 30-day moving average for entries within a weekly stage 2. Position traders often combine weekly stage 2 confirmation with daily chart timing for precision. The model stays constant. Only the risk management and the holding period change. Setting up a Weinstein-style chart is deliberately simple. Step 1. Open a weekly chart. Step 2. Add the 30-week simple moving average. Step 3. Add a relative strength comparison versus the S&P 500 or the Mansfield Relative Strength indicator if available on your platform. Step 4. Add volume at the bottom of the chart. Optionally, draw key horizontal support and resistance levels where base is formed. Weinstein avoided clutter. The goal is clarity, not complexity. A clean chart with these 4 elements contains everything you need to classify any stock stage at a glance. Weinstein warns against 3 costly mistakes. Mistake 1. Buying too early in stage 1. A possible base is not yet a trade. Wait for the stage 2 breakout confirmation. Early buyers in stage 1 often get punished by whipsaw action. Mistake 2. Entering a breakout without volume confirmation. A price breakout on weak volume is often a false move that snaps back into the range. Volume reveals institutional conviction. Mistake 3. Ignoring relative strength. A stock can rise in absolute terms while underperforming the S&P 500. If Mansfield RS is declining during a breakout, the move lacks leadership and is more likely to fail. Every stage classification in the Weinstein method rests on 3 pillars that must align. Pillar 1 is the 30-week moving average trend, rising, flat, or falling. Pillar 2 is Mansfield relative strength direction, above 0 and rising, near 0 and uncertain, or below 0 and falling. Pillar 3 is volume behavior, expansion on breakouts, contraction during consolidations, or heavy volume on declines. When all 3 pillars align bullishly, you have a high probability stage 2. When all 3 are bearish, you have stage 4. Mixed signals mean you should practice patience. The true value of stage analysis is not prediction. It is classification. The method does not tell you where a stock will go next. It tells you where the stock is right now, and that knowledge alone eliminates most major investing errors. You avoid buying into a stage 4 decline because the chart clearly shows a falling 30-week moving average. You avoid holding through a stage 3 top because volume and relative strength deteriorate before price collapses. You avoid chasing extended moves far above the moving average because you know the best entries are at breakout points, not after parabolic runs. In our next episode, we move from theory to verification. You will learn how to test the Weinstein method on historical data before risking real capital. We will cover survivorship bias, concrete backtesting tools available to retail investors, and how to build a statistically valid sample of stage 2 breakouts. It is one thing to understand the theory, but testing it yourself is how you gain the conviction to trade it. See you in the next episode. Backtesting, test before you invest.